Good morning, Emily.
Still Daniel.
Isn't it supposed to be Emily's week?
She's off living her best life right now in either Croatia or Slovenia.
Well, I guess we'll just have to make do here in Longmont. Poor us. Well, anyway, what are we talking about?
I have a ton of questions from a well-known financial journalist for the Wall Street Journal. Essentially, questions to ask a financial advisor, and I want to ask you those questions, and then see exactly how we align with their answers or his answers, and what he's recommending essentially.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, so we're doing, I'm going to guess, the Jason Zweig questions here.
We are. So let's start from the top here. Uh, are you always a fiduciary, and will you state that in writing?
Yes. And that is stated in writing for us in a bunch of places. So we have our service agreement, which explicitly states that we're fiduciaries for our clients. We have our code of ethics in our Form 80V disclosures that says that we are fiduciaries for our clients. And then, as a firm, I'm a CFP professional. We have to be fiduciaries when rendering financial advice and doing financial planning. So then that applies essentially in all of our professional contexts. I'm also a NAPFA member, National Association of Personal Financial Advisors. So then I also have a fiduciary ethical requirement there. And then I'm also an XY Planning Network member, which means, again, also a fiduciary for clients when doing financial planning and financial advising. So I'm a fiduciary, I think, 5 times over, both legally and ethically.
Well, the good news is that matches Jason's answer, so we're off to a pretty hot start there.
Hey, I'll take a hot start when it comes to being ethical and, prudent practitioners of financial advice.
Yeah, they say a financial planner's favorite answer is it depends, but this is one of those that I think is almost a non-negotiable, right? This answer has to be yes if you're serving clients, in my opinion.
Yeah, I mean, I'm always trying to be very open about the possibility that somebody doing financial advice could not be a fiduciary for certain specific reasons, and I just find that the more and more I work through the fringe cases, the less and less they make sense. I think I used to be more generous about that, and as time has gone on, I've just really come down to like, I'm sorry, but if somebody is trusting you with their life savings or their financial welfare, or for that matter their legal, tax, medical, any version of their welfare, you should have to act in their best interest.
Does anybody else ever pay you to advise me? And if so, do you earn more to recommend certain products or services?
Interesting answer here because as a firm, like at the client level, no, just point blank, no. We don't receive revenue sharing. We don't receive commissions. We don't receive sales compensation. We are solely paid by our clients. All of our revenue comes directly from clients, from client accounts. We don't have any other one. What I'll say here, in sort of a strange sense, is for you as an employee, you have a slightly different answer because technically, if we really dig into it, we pay you to advise clients. Yeah, so maybe a little bit circular there, but technically, yes, you are paid by other people to advise them.
I get the technicalities there, but I think for the context here, the answer is essentially no, which matches Jason's answer. But for this one, it's interesting, right? Because I think commissions can cloud judgment and it create conflicts of interest, and revenue sharing can be tricky. But would you ever, to play devil's advocate here, people can do good planning, and still have these conflicts of interest. It can just make it considerably harder. Would you agree with that?
I think it makes it harder, but also I think to some extent, it just seems like a very strange case where something could be in a client's best interest and also cost them more in or otherwise maybe not cost them more but somehow simultaneously be in the client's best interest and also provide more compensation for the person recommending it. Studies on performance of investments and various products over the years are pretty inconclusive about what creates performance, but they are pretty stringent about the basic correlation between the idea that the higher the cost of the thing, the worse the performance of the thing will be. And I think that's just sort of a basic math, right? If it costs you X percent more, then that's X percent more value that also needs to be generated to make up that difference.
Do you participate in any sales contests or award programs that create incentives in favor of particular vendors?
No, not at all. It's sort of the same answer, right? We don't accept commissions, sales rewards, and ideas for people who don't know. I've heard of things like life insurance companies sending people to Costa Rica if they sell at least 10 life policies from that carrier in a calendar year. I've seen awards for things like trips to luxury resorts or, even, for example, back in my fee-based days, right as I was leaving that firm, they had come up with a sort of lottery-based award or raffle-based award where for every dollar you placed in certain advisory programs, you would be entered into a drawing for essentially like a trip to, I think, Napa was the first year award or something like that. So there's lots of that sort of stuff in the financial industry. We still, even though we don't get directly compensated, paid, et cetera, by these third-party vendors, we still get invitations all the time to go to like luxury resorts to listen to wholesalers, or invitations to like the steak dinner or the lunch out or something. And it's always ostensibly just to tell us about their products and services, but there's always kind of a wink and a nudge going on there.
Yeah, matches Jason's answer, and there's something almost unprofessional in my eyes about being a quote unquote financial professional and selling something to a client, fully knowing it's funding your trip to Cabo or whatever the thing is. It just doesn't sit right with me, so I'm glad that's the answer here too.
It's interesting that you say that, though, because at least internally to the firm, and again, I know the question that Jason, I think, is trying to get at here is more to do with like third parties trying to incentivize you to sell their particular stuff or recommend their particular stuff. We do actually have internal incentives, though, right? So, like, you have an incentive for just bringing on clients in general. Right, you receive a bonus whether they come through firm marketing or whether you bring them in yourself. And then also, in total fairness and total disclosure, right, if you onboard enough client revenue in a given year, you are given an incentive to potentially go to certain conferences as part of your compensation and part of your professional development. Now, that is something where that is not affected by the recommendation, right? Whether the client signs with us, what their fee is doesn't differ based on whether they then invest with us or don't, or whether they take our insurance recommendations or don't, or anything like that. But just, I think, in that spirit of full disclosure, right, there we do internally have incentives around growing the firm, growing the business, that I think people, I think, logically would be aware of. So it's not so much as a conflict of interest, but I guess in maybe a very fringe case, somebody might not be a good fit client, and maybe you're $1,000 shy of getting your next conference, and you just say, "Hey, become a client anyway," and you won't be a good fit client, but I'll get to go to the conference. I've never seen that behavior demonstrated, but I'm just trying to be as like ungenerous as possible in thinking about how that could potentially arise as a potential problem.
Yeah, I think that's completely fair. Uh, I don't believe any of those conferences are in Cabo, are they?
No, although I would like to take the team somewhere overseas sometime. I honestly would actually rather go to like Hawaii than Mexico, but time zone differences and all that makes Mexico probably a better choice.
Fair enough. All right. Well, will you itemize all your fees and expenses in writing?
Sure. This is also pretty darn easy for us, just because our basic fee structure for essentially all planning clients is 0.5% of net worth as an annual fee, billed in monthly increments in arrears. For some legacy investment only cases or fringe cases where we're only doing investment management, we charge 1% of assets under management, again, as an annual fee, billed monthly in arrears. For company retirement plans, based on the amount of assets in the plan, we charge somewhere between 0.06% or 0.5% of the plan assets annually, again, billed in monthly increments in arrears. Those are our only sources of revenue. The only exception I could possibly say is I technically still get a little bit of like royalties from my book, which is for financial planners trying to get into the financial planning field, but it doesn't really count as like a line of revenue. I think I've made like $3,000 in 3 or 4 years off of that. It's like it's not a big money maker. I think I've barely broken even on the cost of making it. Anyway, all of that to say, like when we say, will you itemize your fees and expenses of writing? Sure. We do that in our service agreement. We do that in our disclosures. If a client said, do the math for me, very easy math to do. And we do it with clients before they become clients. They understand the full cost of what they're paying monthly, annually. And if that ever changes, we disclose that to them in writing on a going basis.
Yeah, it's funny because this one's so easy for us, right? But the amount of people we speak to that work with a financial professional from, insert big box firm and have zero clue how much they're paying is actually astronomical. It's a lot of people. Is it that easy for them too, or is it because they have, various ways to get compensated, whether it's revenue sharing or commissions, as well as, salary from the company and, sales quotas?
I mean, that's a really good question. I think for a lot of people, the funny thing is that they actually probably can't answer the question. It's interesting if you go watch financial advisors in like a forum like Reddit talk about what they're paid. You'll see a lot of them talk about what's called the grid. At a lot of firms, the grid is essentially a calculation of a percentage of revenue generated or a percentage of some sort of crediting scheme that they have internally. So, like if the firm is attached to a bank, maybe they don't, literally make revenue from bringing in deposit dollars, but maybe they'll get credit for, for every $1,000 they get 1 point or something like that. All of that said, the basic mechanism for a lot of firms is this percentage of revenue generated, and that often then becomes an issue where many advisors don't actually know all the ways the firm makes money. So a lot of advisors might say, "I charge 1% to manage your money." And that's all that I get paid based on. But the firm, and by extension, the client might end up with more revenue, and the client might end up paying more based on product selection, based on platform fees, based on administrative fees, trading commissions, and ticker. Like there's all sorts of stuff that can really be either hidden or baked in or not be explicitly disclosed. That makes it so maybe an advisor is generating 1%, but maybe the client is actually paying 1.25 or 1.5% all in for their services, and the firm is taking a quarter of or a third of the overall revenue that the client is paying in, even though the advisor only thinks of themselves as charging 1%.
Yeah, I could see where that could get complicated then.
Yeah, I mean it is the subject of many lawsuits, for a reason. A lot of firms have paid out some pretty substantial fees and fines, and it's interesting because there's even case like recently Vanguard, which is sort of the patron saint of low cost index products. They just had to pay a $19.5 million fine because they said like your website and a lot of the materials, your advisor is not financially incentivized to recommend certain products or services to you. But then the advisor's bonuses and raises and annual performance reviews heavily reflected how much they did or didn't bring in terms of investment dollars to Vanguard. So even in a case where somebody writing the disclosures didn't think there was a conflict of interest there, when you actually boil down the conflicts of interest around owning product companies versus brokerage platforms versus being the advisory firms, there can be a lot of costs that clients incur and that advisors may not even realize they're creating for their clients.
Are your fees negotiable?
Ooh, that's an interesting one. So, our service agreements and our Form ADV and whatnot say yes, but I'm going to say no because I think that yes is not quite what people understand it to mean in a practical sense. So, what I mean by that is, our fees for service, right? 1% for assets under management, or 0.5% of net worth, with generally sort of a range of 0.04% to 0.68% for product costs. Averages maybe to 0.05%. So call it 1.05% all in for an investment only client, or 0.55% of net worth for a net worth client, even though they would not necessarily all be investable. All of that to say, when you actually look at the benchmarks, and I'll share an example of this for those watching on YouTube, when you look at the benchmarks, we are incredibly competitively priced for most clients of most asset levels. Our planning service is probably too expensive for somebody with $250,000 in assets or below, or a net worth of $250,000 below. But once we hit the kind of 500,000 and beyond point, our planning service is incredibly competitively priced compared to the marketplace, and our planning or just our investment management service only is incredibly competitively priced, essentially all the way up until you getting into the neighborhood of like 5 million, $10 million. So All of that to say, our fee is not generally negotiable because it's already very competitively priced. If the argument for negotiation is just, I want to pay less. Now, we do allow some room for negotiation, particularly, and we do this more affirmatively. We'll exclude certain assets from a client's portfolio or from their net worth calculation. So things like kids' accounts, 529 plans, or, loosely valued privately held businesses, your 1/10 owner of a motorcycle shop or something like that, where you probably don't have a real appraisal of genuine valuation to count. We'll generally try to err on the side of excluding or heavily discounting that. Or maybe like a really, really fractional ownership, 1/36 of 10 acres of, land your family has inherited from their great 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 grandfather, and you pay $7 in taxes a year, and you're not going to invest it or sell it or do much with it at all, and so there's no real value to be added there. But otherwise, generally speaking, our fees are typically not very negotiable, simply from the standpoint that, again, they are very competitively priced for clients in the marketplace for the cost of these types of comprehensive services. And so it's going to be kind of a rare niche or exceptional case to really get a negotiated price.
Oh, when you say all that, it sounds fair, which is interesting because in this context, Jason's answer is yes, that fees should be negotiable. Why do you think there's maybe a difference in the answer on our end versus his?
I think that Jason is writing for the consumer in this case, and that's his constituency as a journalist, and fair enough. I think it's also fair to just say if you have to have a black and white answer of yes or no, you should probably want the answer to be yes because hey, why not? But what I'll say here is, many firms are not that cost efficient in terms of they might charge quite a bit for their services, and they may not make very much on that. To give you some idea, today, if I did the math this morning, we have maybe about a $250 to $300 margin per client that we serve. That's about, and that's across all clients. Not all clients are paying the exact same amount. Right, some clients pay a lot, some clients pay a little, some clients we essentially lose money on. Because to give you some idea, that approximate figure is about $4,900 a year on average across all clients is kind of the revenue level, and our expenses to serve those clients over the same kind of 12-month rolling period is about $450 to kind of $4,500 to $4,600 per client. So, it's something where he can say like, oh, they should be willing to negotiate with you, and you should look for somebody willing to negotiate. But that removes the possibility or creates the presumption that there's a really large margin to be had in your client relationship, and that the services are not already well priced or effectively priced based on the costs incurred by these professionals to provide you with this advice.
All right. Will you consider charging by the hour or a retainer instead of an annual fee based on my assets?
Straight up here, no. And I can fight this one from the top of the hill and win that fight because this is my research specialization. So, challenge me, Daniel. Make the argument for Mr. Zweig.
Well, Mr. Zweig says yes, Dan. Charging by the hour or retainer as opposed to, an annual fee for assets. What if I have a very nuanced question, right? Hey, should I do a Roth conversion this year or not? I do everything else myself, right? I might just need an hour of your time, or to poke you once a year for a quick question or two. What's wrong with that?
I don't think there's anything wrong with that. However, I think we're painting with a very broad brush here. I think Jason's answer of yes, that you should find somebody who charges by the hour or a retainer instead of an annual fee based on assets presupposes a certain type of advisor-client relationship. It presupposes a certain set of needs. It presupposes a certain set of circumstances. It presupposes a certain service model or type of deliverable that the advisor can or will or should provide. And that is not a universal truism. For example, I think an hourly planner makes sense for the exact case that you described, right? I have one particular financial question. I only need the answer to that question, or I think I only need that type of question. I don't want help implementing the answer. I don't want assistance, working through it. And I have no questions, nor do I want to hear about any what ifs or what abouts or it depends factors. I just want your point blank answer to my question. So here's my question, do the math, give me my answer, done and done. This presupposes that somebody doesn't want ongoing service. This presupposes that somebody doesn't need ongoing service. This presupposes that somebody doesn't want to delegate things like their portfolio management to a professional or have an ongoing relationship, or that somebody does or does not want to engage in paying by the question, paying by the minute, paying by the hour. Um, I think the basic presupposition here is a fair presupposition, which is a skepticism about the cost to value. A very large portion of the industry charges based on assets under management, and all they do for that fee is manage money. They don't give advice, they don't do planning. And I think in that context, I think Mr. Zweig's skepticism is quite valuable because I think that an assets under management fee can still be a good alignment for investment management only. I just don't think that it's worth 1.5%, 2%, 2.5%, as many firms may charge for that. I think that there's a very competitive market for purely investment management relationships. But I think to paint with a broad brush and say you should not work with an assets under management advisor or percentage of something or other advisor, and you should only be looking for an hourly or only be looking for a retainer type relationship, really ignores the scope and breadth of both the types of clients that are out there and the financial needs that are out there, and also the scope and breadth of the types of firms and professionals out there who are providing services in an enormous variety of ways.
Yeah, I mean, you make a pretty good argument there. I got nothing to say.
Again, if Mr. Zweig can beat me on this hill, I'm excited to hear his argument, in person sometime. But this is my research area. A lot of people like to argue about this. If you want to catch financial advisors at a bar and start a fight, just say, "I think fill in the blank fee model is a bad fee model," and just watch them go at it. But realistically, I think this is one particular area where the brush is way too broad, and the point is being made far too generally and ignoring too many of the nuances that are relevant to the question.
Can you tell me about your conflicts of interest orally or in writing?
Yeah, I mean, our conflicts are generally disclosed in our services agreements, our Form ADV. They're supposed to be the required, but those are big, lengthy documents. I think the basic oral answer here is, we make money when somebody is a client. We don't make money when they're not a client, first and foremost. Again, all of our revenue comes from having client relationships. I think the biggest conflict of interest we have in practice is that we are incentivized both by the fact that we can add value and get credit for the value, but also by the fact that it can potentially create some inflation adjustments to our fee to manage assets for clients. When we charge our 0.5% fee, we do that as an annual calculation, but when somebody places assets under our management as part of that arrangement, regulators have told us that they want to see that treated more like an assets under management fee, where the percentage shouldn't be changing, and therefore if the percentage isn't changing, then the fee level has to go up or down with the value of the underlying assets. So that can create a bit of an inflation adjustment that creates more intra-year revenue for us as a firm, although it can also cost us revenue if somebody distributes a bunch of money or the market goes down or something like that. But it does create a conflict of interest in that client relationships where we do both planning and investment management tend to be a lot stickier and long term than standalone planning or standalone investment relationships.
Yeah, I think that more or less aligns to Jason's answer, which is yes, you should be able to do this. I think what's important here is just essentially be wary of anybody that says they have no conflicts of interest and are, a quadruple fiduciary and have nothing swaying them in one direction or another. We all have conflicts of interest. I think it's just important to align, what you're looking for in terms of services with conflicts of interests that you're okay and comfortable, in that professional having.
Yeah, I mean, I think you couldn't say that better.
All right. Do you earn fees as an advisor to a private fund or other investments that you may recommend to clients?
No, and also this is, and I'll take that a step further. This is sort of my most controversial opinion. I think it should be against the law to be in the advice giving business and also the product distribution or product creation business in this industry. I think Dick Wagner put this really well in several of his writings, but he essentially put it this way: they are not us, and we are not them. Now, this creates some fringe, weird cases where maybe like a financial advisor at Vanguard now can't give advice that somebody should invest in a Vanguard index fund. So I can see kind of a world here where there's cases where that rule doesn't make sense. But if you say, Dan, you're king for a day, shall people have the ability to offer products in addition to their advice? My answer would just be no.
Yeah, I think there's a couple other things you'd do if you were king for a day too.
It's a long list, Daniel. I'm trying to keep it short.
No, I think that's fair. I mean, it's frustrating when, we meet with somebody who says, "Oh, I have a financial planner," or "I had one," and then they mention where that planner, quote unquote, is from. Um, and you see the quality of the plan or lack thereof. And it's frustrating sometimes, as you said, right? They are not us, we are not them. But to be associated or even put in the same conversation as people who are just simply pushing products or have sales incentives and really just focus on that.
Yeah, I mean, it is tragic that when you see clients from certain firms, particularly big name firms, you can essentially make an educated guess with probably a 90% accuracy rate about what their money is going to be invested in or what products they're going to have in their overall financial situation. And frankly, it should not be so easy.
Do you pay referral fees to generate new clients?
We don't. And my basic answer for this or reason for this is I think if a professional or a client or anybody else is going to recommend us, I want them to do it because they think it's in that person's best interest, that they think we are the best or one of the best possible providers for them. I don't want somebody to come to us just because we're paying their CPA, $100 to send us a name or their lawyer money to send us a name. There are big referral marketing lead generation platforms that charge enormous amounts of money for planning leads. We could probably grow a lot faster as a firm if we did this and make up the difference in the cost and all that. But again, I want somebody to come to us with a full comfort and belief that they're coming to us and being told to come to us because we are the best option for them or one of the best options for them, not because whoever sent them to us was getting a $100 check in the mail.
Yeah, I mean, aligns with Jason's answer, aligns with my opinion. I have nothing there.
Super easy.
So, do you focus solely on investment management, or do you advise on taxes, estates, retirement, budgeting, debt management, and insurance?
Uh, yes, if I'm hearing the question correctly, we do. It's easier to say what we don't do. We're not a law firm. We're not a tax prep firm, and we're not a bank. If you exclude all of those things, and then maybe also just exclude we're not brokers or insurance agents, then if it's a financial issue or topic, we're going to support it or help with it. So, we don't do tax returns, we don't write legal documents, we don't take deposits, issue loans, we don't act as custodian or trustees, we don't sell investment or insurance products. But otherwise, if it's a financial question or financial topic, we're going to be involved in it. And even if you have a need that falls into one of those categories, we're happy to be part of the conversation and be giving advice. We're just not in the business of doing those particular things.
Makes sense to me. That more or less, aligns with my opinions here. Um, I guess it depends on your needs, right? Jason doesn't really give a black or white answer here, but I assume we don't do all these things for all of our clients every year, do we?
I mean, we try, right? We have an annual service cycle where, kind of on a quarter to quarter basis, we are trying to cover every element or facet of their financial situation. So we're looking at insurance, we're looking at estate, we're looking at investments, we're looking at their real estate, their vehicles, their cash flow, their debts, liabilities, their college savings plans, their education plans. We're trying to look at everything on a regular basis because there's the stuff that kind of pops up as urgent in your life, like, oh my gosh, we need to move, so we need to get a mortgage and figure out how to sell our house and do all this stuff. And that's event driven, but there's lots of stuff in your financial life that really demands maintenance that's easy to forget about or go into a deferred maintenance sort of approach to. And so we really try to make sure we're touching on all the facets of a client's financial life at least once a year.
Makes sense to me. Yeah, it's pretty easy for things to fall through the cracks. If anybody listened last week, I still need to update my estate plan. So,
Deferred maintenance, Daniel. You got to stay on top of it.
all right, similar to the two questions ago, do we earn fees for referring clients to specialists like estate attorneys or insurance agents?
No, and the same logic as the other one. When I send a client, a friend, a colleague, whoever it is, to somebody, I want to send them to them because I think they're the best possible provider or one of the best possible providers for their particular need. As a fee only firm, I think it's not only against our rules, but also I think just bluntly unethical to recommend that somebody go to a lawyer or go to an accountant or go to any other professional because we're getting a kickback for it. So not only would it violate our fiduciary ethics, but also, again, I think just in general, it's absolutely just a violation of basic principles of ethics to take money from people to recommend them for those reasons.
Yeah. Uh, Same as the last opinion for the similar question, but yeah, we have tax preparers, insurance agents here in town. We love doing business with, not because they pay us or we pay them, just because they do really great work. And, I'm happy to buy them a beer or a dinner one day because of that. But I hope that's not the reason that they keep bringing us folks and we keep bringing them folks.
It's a strange thing because, again, I mentioned earlier, like the wholesalers. I don't know why any professional would, steer their clients wrong or to a less than optimal solution over the steak dinner or the barbecue or like the tickets to a movie, but it happens, and it's just very bizarre to me.
Must be a really good movie or a really great steak.
One can only hope.
So, what is your investment philosophy?
We're gonna start getting into Plato and Aristotle here. Now, I think very succinctly, the best answer to this is we are not going to beat the market. Is our investment philosophy. And that's not a statement about saying like we're going to underperform or do terribly or something like that. It's a statement that our investment philosophy is largely derived from the principle that some of the best educated, best resourced, highest budget firms for investment research that beat the market failed to do so. I always think about Bill Miller, who, for anybody who doesn't know, used to run a value fund for like Mason, was essentially the best portfolio manager in the world from like 1991 to 2005. And then the decade following that, 2006 to 2015, was in the bottom 4% year over year for the next decade. Right, so somebody who was objectively the best in the world for 15 years then became one of the worst in the world for the last 40% of his career. I always keep that sort of thing in mind because somebody like Mr. Miller, had all the resources in the world to do the best job possible, and there's all these big investment companies that supposedly have all the resources in the world to do the best job possible, and the data is just not on the side that they will outperform the market in any serious sense. And from our particular perspective, as a four-person firm in Longmont, Colorado, that doesn't have all the resources in the world, we're definitely not going to. So our investment philosophy is we're going to buy low-cost index funds, and we're going to be more or less aggressive in alignment with what the client's financial plan dictates as a necessary targeted rate of return and risk for their plan to function. No more, no less.
Jason actually doesn't have a recommended answer here, and I'll share my thoughts until we answer a couple more questions because the next couple are investment related. So, do you believe in technical analysis or market timing?
No, and for anybody who doesn't know, the joke about technical analysis is that it is zodiacs for men or astrology for men. It is, just tea leaf reading of the dumbest type, where it's interesting, it's fascinating, and for anybody who's not familiar with it, technical analysis is where you see like the pictures of the fancy like bar candlestick charts, and like there's stuff going up and down, and people are like jumping in and jumping out, and it's all about just like reading the tea leaves of the movement of the market or the movement of a particular asset. We have no belief in that whatsoever. And then same thing for market timing. The closest we get to market timing is a desire not to stand in front of oncoming trains. And my example of that is we do a little bit of interest rate adjustment or duration adjustment in our fixed income portfolios. And it's largely just around, hey, if the Fed interest rate is zero, that's fine, but that means that if they raise rates, long-term bonds are going to get hit really badly. So we should probably not hold those when rates are super duper low. And conversely, when rates are relatively high, maybe it makes more sense to hold longer term bonds because if there's an anticipation that rates will come down, then that'll produce a premium on the value of those. That's as close as we get to anything related to market timing. And we're timing in the genre of like several years at a time here. So we're not like jumping in, jumping out, making decisions day by day in that sort of sense.
Got it. So, do you believe you can beat the market, Dan?
As our investment philosophy already states, absolutely not. The funny thing is, we have beaten it, depending on the benchmark or the thing you look at, in a couple of instances from time to time. Like we technically have a positive alpha on our most aggressive portfolio right now, and like that's cool, but that is, I think, a fluke more than anything. That was never the intent to beat the market or outperform the benchmarks in any way. And we've had, real surprisingly strong returns over the last several years. And I say that, and I now say with great caution, I would never expect that to be the norm or consistent over time. I think that is an absolute fluke of timing and measurement. I have no belief or desire to believe, and nor do I want anybody to ever listen to me say this, right? And come away with the belief that somehow we're going to do great or do stellar or beat the market in any sense. It is just a strange fluke that it's happened in a couple instances, and I think more realistically, we should expect to match the market at best or underperform it in general.
How often do you trade?
So, basic answer here is we don't trade, I think, in the way that this question is being asked. Like, I think it's asking, like, are you spending all day looking for opportunities and selling this and buying that? Our answer here is essentially rules based. When we assign clients a portfolio, right, we have certain model parameters. We say you're going to be 40% this and 13% and so on. We then have tolerance bands, essentially equivalent to a 20% variation from that. So if your position was supposed to be 10%, if it is within 8 to 12%, we're not going to trade it. But if it gets bigger than 12% or smaller than 8%, then that would trigger for us a necessity to do some trading to bring that back into alignment. That has more to do with keeping long-term risk-reward issues in place, less than it does trying to like find the most opportune this, that, or the other at the right time.
Yeah, I think Jason's answer here is as seldom as possible, or ideally once or twice a year, which, like I said, or like you said, I think this question more pertains to like day trading and looking for opportunities and such. That being said, is that something we're doing in conducting research for the actual funds we have for clients' portfolios?
We do a pretty good job of keeping a very ongoing view of the investments that we recommend for clients. Part of that is that we don't have a very large list, so we don't have like 200 funds we're keeping track of. We have about 13 different funds we're keeping track of directly, and then we're looking at them in comparison to their peers and their closest match peers. So we're not looking at all 17,000 funds out there. We're looking at 13 and then plus or minus 3 to 5 in comparison to those 13 on a going basis, and that's really where we kind of keep our focus.
All right. How do you report investment performance?
So we use a time-weighted return calculation, which essentially is a calculation that ignores cash flow. So it ignores you adding more money to the portfolio or you distributing money from the portfolio as part of the calculation. This differs from internal rate of return, which is really appropriate for something like a real estate project where you can account for like real estate appreciation, but also account for mortgage payments and rental payments, that sort of thing. So we use a time-weighted return. That return is also reported net of expenses, net of fees. So it is a genuine return number that accounts for all the costs before giving you a return figure. And then we report that in kind of high level detail in a monthly email, in a greater level of detail in a downloadable report. And then we're also reviewing this in the context of a financial plan on a going basis with clients.
You might have said this and I might have missed it. Does this include dividends and interest being reinvested as well?
Yes, I think it's difficult to ascertain from a portfolio what its return is if you ignore cash flows. And even things like big, benchmark indexes don't do nearly as well if you ignore their dividends. For anybody who's not aware, dividends are if I have $100 in stock value and a $5 dividend comes out, then I end up with $95 in stock value and a $5 dividend. So if you ignore dividends or you ignore interest payments, then you're fundamentally kind of misreporting what's happening.
Okay, great. More or less aligns with Jason's answer here too. Do you believe, right? So we tell clients to invest for the long term, but we send out these reports semi-frequently. Do you think that sometimes might send mixed messages that we're, kind of emphasizing how we're doing in the short term?
I think it's a good question. I think in a perfect world, no one would pay attention to their portfolio at all, and they would just leave it to the fund managers or the professional managers, or they'd buy a target date fund or something like that and just sort of set it and forget it. Because the more you look at it, the more you engage with it, the more potential emotional impact there is, whether it's anxiety or elation or fear of missing out. In that the big reason we report stuff so frequently to clients is we charge monthly. So then I want to be very fair and say, hey, like we have taken money from you for services that we are rendering, and I want to give you something to compare those costs to. That's probably the biggest thing. I feel like as a fiduciary, I need to report those things to a client because they are happening. But also from that standpoint, at the same time, in a perfect world, I would love it if every client just trusted us 100% and ignored it entirely.
Okay, that's fair. So which professional credentials do you have, and what are their requirements?
Well, I mean, as a firm, we have quite the collection here. So I guess I'll answer for me, and then maybe if you want to answer for yourself, and we can talk about Emily for her sake, since she's not here with us at the moment. I have a PhD in personal financial planning. I have an MBA with a concentration in finance. I'm a certified financial planner professional. You're required to say it that way. I am a chartered financial consultant, an accredited investment fiduciary, and a NAPFA registered financial advisor. Requirements. PhD took me 5 years, 90 graduate credit hours, passing of comps exams, and doing original research and publishing it. MBA took 2 years, 40 graduate credit hours. A quarter of the credit hours were in the financial administration track. Being a certified financial planner professional requires a bachelor's degree, 6,000 hours of experience, passing of 7 graduate level classes in financial planning, and then passing the CFP exam. And then that requires, on a going basis, 30 credit hours of continuing education every 2 years. Chartered financial consultants, I believe, requires 3 years of experience if you have a master's degree, 8 graduate level classes in financial planning, and then passing exams for each of those classes. Accredited investment fiduciary. This is a dedicated class and education around fiduciary asset management and practices. So it really looks at things like retirement plans under ERISA. It looks at trusts and those sorts of things. The ongoing burden is fairly low there. That one is 5 credit hours a year. And then I am a NAFTA registered financial advisor. It's the National Association of Personal Financial Advisors. And you just have to be a fee-only CFP professional to obtain that, but then you have to do 60 credit hours every 2 years on a going basis.
That's it.
Just a little bit.
All right. Um, I think it's important, right? Have the CFP or look toward getting the CFP. Would you say the remainder of those are not? I don't know if importance is the right word here, but are necessary to look for in a financial planner?
I think the table stakes absolutely necessary one is going to be the CFP. And I say that advisedly, looking at you and Emily as folks who are working towards your CFPs right now. So then you are supported by me and mentored by me as a CFP. Much as I love my PhD and my getting to be Dr. Dan and all of that, I don't think that's necessary at all, but it's really cool. I think an MBA is probably not necessary in the slightest for a financial advisor unless they work with a lot of business owners. And then it just sort of helps as a broader, more general understanding of all of those sorts of business things. I think it's also helpful if you want to run your own practice. I think the chartered financial consultant is just sort of an alternative to the CFP certification. When you boil it down, it has slightly more education and slightly less exam requirement. And so I think that one is similar but different to the CFP. And I think if you have to pick CHFC versus CFP, you want the CFP. The AIF is more about specialization. I think the AIF is something to look for if you are looking to engage somebody as a investment manager for your 401k plans, or if you're looking for somebody to manage trust assets for you. I think it's a good specialization to look for. In the NAPFA registered financial advisor, I would like to say that everybody who's a financial planner should have to be a NAPFA financial advisor, just because there's that additional layer of ethical requirement, education, and so on. But is it like a hard requirement? No, not necessarily.
Okay. Yeah, I think a lot of certifications can end up being marketing tools, right? That kind of masquerade on an advisor's wall, and you see all these nice frames and stuff, and clients have no idea what they are. Not to say you don't learn things from them, but I think the CFP is really one of the utmost importance, and everything else is kind of ancillary.
I think there are some other really high touch ones that are not quite as financial planning centric, right? Like if you're looking for somebody who's going to be like incredibly good at portfolio management at like a stock trading level, you probably want a CFA. Which is a chartered financial analyst. That's sort of the same. That's sort of the gold standard for people who work at fund companies or product companies, the same way that being a CFP is here for us as financial planners. I think if you are looking for somebody who has a tax specialization, you're probably looking for somebody like Daniel here, who has his EA, or a CPA who runs a tax practice, or maybe it's a hybrid tax preparation and financial planning type of practice. There's a couple of other really good ones out there that are not marketing designations. Even like Emily is a financial PR planning qualified professional, which is sort of a CFP light, which I know people get mad when people say that, but it does just sort of gently brush on all the financial planning topics without going into too much depth. I mean, there's a lot of stuff like that I think is helpful. But I would say the biggest, green light, red light sort of thing would be, do they have a CFP? CFP, or if they don't have a CFP, are they working in a firm with CFPs and clearly working with those CFPs on your plans?
All right, last two here. After inflation, taxes, and fees, what's a reasonable estimated return on my portfolio for the long term?
I say in a gross answer, most people should target something like a 5 to 9% rate of return. I say that in the context of long-term averages, is in the context of a inflation rate being 2 to 3% long-term average. So that's the context when I say gross rates of return. When the question here is net inflation, net of fees and taxes and all of that, I think you probably want to cut those numbers in half and round down to some extent. So I would say, for somebody with a conservative portfolio, when you factor in taxes, when you factor in fees, when you factor in inflation, 1-2% at most. I think on the aggressive end, 3.5-4.5% at most. And again, I think that's going to be heavily dependent on, are we investing in Roth and IRAs? Are we investing more in, taxable brokerage accounts and that sort of thing?
Yeah, I think here the thing to keep in mind too is just be wary of anybody that says, 10%, 15%, right? Anything that seems too good to be true, probably is.
Yeah, and I mean that's sort of the thing where, like, we have portfolios. Like, we've been doing portfolio reviews with clients throughout most of Q3, and I've gotten to tell a bunch of clients, your return for the last 2 years, 3 years, 4 years, 5 years has been 10.5%. Has been 11%. I have a client right now who's been with us for around 2 years, and their average rate of return is just under 20%. That's awesome. That's completely unrealistic as a long-term expectation. So that's where, again, I will always say happy that it happened, but also completely unrealistic, and we shouldn't expect that to continue.
Who manages your money?
Me, super easy answer here. I manage all the portfolios here at my wealth planners. I manage money for myself, for my wife's accounts, and we invest everything in the same things we invest in for clients. I'll call out 3 exceptions to that, just to be very, very transparent about it. One is that I have a little bit of money in SWPPX, which is Charles Schwab's S&P 500 index, and that's sort of my rounding error fund, where if I have like 7 cents left over after trades, I will just go ahead and stick it there so it's not sitting in cash. I have an HSA over at Fidelity because Schwab doesn't have a good HSA option. I invest that in FCROX, which is the Fidelity zero fee total stock market index fund. And then the last thing is just, we have a 401k plan here that doesn't allow us to invest in ETFs. And so I just invest in the equivalent Vanguard index funds that are equivalent to the same ETF funds we use to try to mirror those as best I can.
Yeah, I think important thing to note here, listen to the answer and see if it's different than what a portfolio manager or advisor is recommending you invest in. If there's a substantial difference between the recommended allocation for you and what they're actually invested in, I think that's kind of a red flag.
Yeah, and it's one thing to say, like, hey, my advisor is 60 and I'm 25 and they're way more conservative than I am. Like, that's not quite the issue there. But I think if they're like, oh yeah, all my money is in these funds, but I'm recommending that you use this at separately managed account service or TAMP service, then I look at it and go like, well, hold on. Like, why is one type of investment great for you and terrible for me outside of just how much risk reward there is?
Sweet. Well, thanks for answering some questions here.
Well, as always, the best question we ever ask every week. Question number 20, I think, if I counted up correctly here. Daniel, what have you learned in the last week since you've been on the podcast? Since apparently you are just going to be my co-host here indefinitely.
I don't know. We asked a lot of questions today. I think the mark of a really good professional, whether it's a physician, attorney, financial planner, accountant, whomever, is really good professionals ask really good questions that provoke thoughts and things that you might not have considered before.
I'm going to really hope you already knew that before this week and you're just saying it for the good of the audience. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.